Hey guys, thanks for joining. Looks like we're waiting for Mark still, and we'll give everybody a chance to join us. So we'll give it a few more minutes. Hey Mark, I was just saying we'll give it another minute for anyone else to go ahead and join in.
No problem.
All right, let's go ahead and begin. Obviously, we're here. We just tweeted out that due to hostile market conditions, our impermanent loss protection is temporarily paused. So I guess the best way, Mark, to just kind of jump into this is, we had a community call, a couple of them on Thursday. And I mean, it's crypto and a lot happens in a short amount of time. But as of Thursday, we were pretty confident that the protocol was in a healthy state. And I guess as of right now, I mean, where do we stand? What changed between Thursday and today?
Yeah, it's a really good question. So one is that we found another Celsius wallet that was going to withdraw $10 million from the protocol. And then there's also been a sort of a wave of additional panic on the protocol that resulted in a very, very large amount of withdrawals piling up. And so it really started to look something like a bank run event where it would be difficult to imagine the protocol withstanding such a large flight of liquidity all at once. So it's not even the case that if these withdrawals were sort of spaced out and were being processed in a more organic way, that the protocol wouldn't be able to handle it. I actually think that it would have been fine, but it's kind of this you know this symphony of different factors, from having a someone that really does seem now to be a hostile antagonist against the Bancor protocol, creating short positions and trying to manipulate the BNT price down in order to make that as profitable for them as possible, combined with a very large amount of withdrawals happening simultaneously. We were basically left with a very uncomfortable decision, and that is basically to either let it play out or do something about it. And I think that the ethical thing is to protect the protocol and its users against these types of this type of antagonistic behavior. And so it's really unfortunate, and I am extremely disappointed with our industry that it even came to this. But yeah, it's something that we wanted to make sure that we did, because if we if we did nothing at all, right, there is a good chance that we would be handing over our protocol to an antagonist that is desperately trying to recover as much value as they can, because they might be close to insolvency. And even if there was like a 5% chance or a 10% chance of that happening, we have to treat it as if it's an absolute certainty. And that's why the emergency DAO powers were activated. and we'll be seeking ratification by the DAO for this decision very, very shortly. But it is, yeah, it has become significantly worse over the last few days, and I'm very upset.
Okay, but you're saying that it is a temporary measure,
Yeah, that's
correct?
right. It's a temporary measure. It's a very time sensitive thing, and the institution that we think is performing this attack against the BNT token. If we can call it attack, it's a type of economic attack. They're on a hair trigger, and so anything that we can do to slow that down, we know is going to be able to is going to be able to protect the protocol significantly. And so I don't think that we need to be concerned, because we've essentially taken their weapons away from them, and the Bancor protocol will endure much longer than they can. So yeah, it's going to be very temporary, and I'm looking forward to everything getting back to normal.
And when you say economic attack, just to clarify, I mean, I'm looking at the blog post that we released, and it states that the funds on the protocol are secure. So although the impermanent loss protection is temporarily disabled, and the withdrawals from V2.1, maybe you could speak on that for a minute. The withdrawals from V2.1 are also disabled, correct?
Yeah.
Okay.
Yeah. So withdrawals from version 2.1 have been disabled, but you can still withdraw without impermanent loss protection from version 3 by migrating between the two protocols. And the reason we did this is partly because of the time sensitivity of it, and the fact that we didn't want to introduce too much. We didn't want to introduce any smart contract risk at all, and so the change in the logic required to make this work on version 2.1 is just untenable, and so it just made more sense to remove the ability to withdraw from version 2.1 and instead have the ability to migrate from version 2.1 to version 3 and withdraw from that side. So we've left this this route to withdrawal open, and you can still withdraw without impermanent loss protection as you would from any other AMM, and yeah, that's how we've set that up.
Okay, and I saw a question in regards to withdrawal fee for anybody who is migrating from V2.1 to V3 to be subject to the withdrawal fee.
Yeah, and this is something that I'm hoping we're going to be able to reverse very, very quickly. I think that during this uncertain time, it makes sense to reduce the withdrawal fee to 0.
Okay. So I'm just, for anybody who is on the call right now, I pinned to the top the original tweet, the original announcement from Bancor, and there is a link there to a blog. So I'm really just kind of going through the blog here and discussing it with Mark as openly as we can. So if you want to follow along there, you may. But next, one of the other things is trading remains active, right? Trading is active.
Yeah.
Deposits are currently not being accepted. Right? Can you speak on that a little bit as to the reasons why?
Yeah, for sure. So it's important to leave trading active for a number of reasons. One is that if we freeze up all of the pools and are still trying to facilitate, for example, migrations from version 2.1 to version 3 so that people can withdraw, we really need to make sure that we're convinced that the two different pools that they're migrating between are well equilibrated. The other thing is that if we did sort of freeze trading and create an AMM protocol that is then like thoroughly out of sync with regards to price with the rest of the markets, then it can be a huge nightmare to eventually switch it back on. And remember, we're hoping that this is going to be we're convinced that this is a very temporary resolution to a complex problem. And so it would be really nice to just be able to alleviate these restrictions very, very quickly, without having to deal with the complexities of rebalancing the pools ourselves, and having to deal with that additional complexity. So that's why trading remains open. And what was the sorry? What was the other question, Jen?
No, that's okay. Deposits. It says
Oh
deposits
yeah,
are currently not accepted to prevent confusion.
yeah. So one of the there's technically no reason why the protocol can't accept deposits, although I do take ethical issues with it. I think that when we've got a product that's kind of compromised the way that ours is right now in terms of its product features, we don't really want to be sort of accepting any new liquidity into the system, and we're not really as inviting as we were. Um, the other issue is that it's possible that people may have scripts and other things. We obviously we've been working on a bunch of different integrations over the course of the V3 release, and for a lot of these people that may be providing liquidity via methods other than the app, we can't be certain that they would actually receive the information before committing, liquidity to the system, only to find out that, its IL protection status is temporarily paused. So we thought that it would be much better just to force all deposit actions to revert, and that way no one is, no one's committing to something that they might not know that they're committing to. Because we just can't assume that everyone is using the app, because that's just not feasible.
Okay, so we'll sum up where we've gotten so far, right? V2.1,
Sure.
all the positions in V2.1 are migrating to V3. We're looking to, did you say temporarily disable the withdrawal fee for all users, but without the impermanent loss protection, correct?
Yeah, correct. I think that under the circumstances, I think it makes sense to have a withdrawal fee of 0%.
Okay, so user funds are safe. It's an economic attack, nothing more. And trading continues. That's necessary. Deposits being disabled is strictly an ethical decision. So in regards, I mean, I know that this is a difficult question to ask, but I have to ask it. Is there any sort of a timeline, like a time frame that you're looking at?
I can't give a specific time frame, but I think that it would, it's going to be at least a few days, and I'm not sure how much longer after that. But yeah, we really need to make sure that when we return to business as normal, that a lot of the protocol is in a sufficiently healthy state that it's not going to sort of implode on itself. And I think that we did take pretty good preventative action in this case, and so it's not like that we were right at the brink or anything like that. And I think that we did the responsible thing, and it makes sense that when we reverse these these measures, that we have to be certain that it's safe to do so. We can't put we can't put the project and its community at risk just because we're trying to rush something out. And so yeah, it's going to be tricky, but I'm absolutely confident that we can return the system to normal.
I understand that, and I appreciate what you're doing. Just because I think we've seen so many large protocols or companies, projects, whatever it happens to be, kind of just take this horrible downturn. So I appreciate you taking the measures that you're taking, but it kind of raises another question as far as IL in general. Has
Sure.
anything changed in regards to the vision of impermanent loss protection, or does this still remain like a major fundamental aspect of Bancor?
No, absolutely not. And I think that there's a couple of things that I'm hoping the community, not just our community, but hopefully communities all over cryptocurrency will sort of take away from this. So the first and foremost, no, we don't think that there's anything broken about the impermanent loss protection mechanism at all. I think that one of the things that has driven us to this state is the stress on the BNT token that is mostly a result of liquidity mining rewards over the last 18 months. And hopefully, in this day and age, it's not controversial to point out that inflation is generally a very fast way to lose value. And for I think a lot of people in cryptocurrency, it was inflation in government fiat currencies that originally drove them to the space. And it's just ironic that when they finally end up here, they sort of get addicted to the money printer and become highly reliant on, or at least extremely enthusiastic about, inflationary reward systems. And Bancor did this, back when I was just a community member, and I was pretty cautious about it then. And after beginning work for Bancor as a researcher, I have been doing my best to try and get the community to take it more seriously. And if they, I'm not saying don't have it, but you've at least got to do it responsibly. And it wasn't at all responsible. The emissions on BNT were way too fast and way too aggressive. And I think that it probably did fuel what we can retroactively assume to be a fairly successful, or serving a very successful marketing purpose. But at the end of the day, the economics of the system is the thing that we need to protect and monitor. And the 200 million BNTs that popped into existence over an 18-month period and that were distributed, across the user base, 30% of which was distributed to TKN holders, has done a lot to sort of really exacerbate the impermanent loss of the system. And I can describe a little bit how this works. Imagine that you're starting a liquidity pool for the first time, and you have some number of, let's say, wrapped Bitcoin and some number of BNT on the other side. And you tell someone that if they provide liquidity to that pool, that you'll give them more BNT, and that reward is theirs to do whatever they wish with. And so what's likely is that they're going to buy back their own wrapped Bitcoin with it, and then contribute that wrapped Bitcoin back to the same pool. And so what this does is effectively depreciate the price of the rewards token, in this case BNT, versus the other asset. And this is very, very similar to a lot of other systems that we've seen pop up all over the cryptoverse, not just on Ethereum and not even just in DeFi necessarily, but everywhere. Lots of different projects. And I spoke about this phenomenon a little bit at Permissionless, where there's this kind of this toxic cycle where the rewards token is constantly added to pools in order to extract the other asset, and then contributed back again in order to achieve something like a compounding effect. And so for Bancor, what that did is basically give TKN providers permission, I want to call it, to use the BNT rewards in order to depreciate the price of BNT, while accruing more IL on their position by buying back their own tokens and re-providing them to the pool. And so this mechanism played out for long periods of time has basically meant that the valuation of BNT has been absolutely stressed. And it's ironic because in this case, it is the impermanent loss that is an issue at the end of the day. But the causative element behind that impermanent loss is still the liquidity mining. And there's a chart show that has been circulating around within our liquidity provider channels and other Telegram channels of the impermanent loss versus liquidity mining, measured both in US dollars valuation and in BNT valuation. And it's no accident that during the last week or two, that the BNT value of the impermanent loss has become very nearly equal to the liquidity mining value over the same time period. because these things do feed into each other in a very intimate way. And I was hoping that we would have a little bit more time to kind of reverse some of the inflationary economics of the Bancor ecosystem before these things sort of came to fruition. And I've been fairly vocal, over the last couple of months in particular, as we transition into version 3, about trying to establish a new narrative where inflationary tokenomics are no longer a part of not just Bancor, but I don't think that they have any place in DeFi. And to my delight, the community, I think, has been extremely receptive of that messaging. And the BNT rewards have been mostly shut off from. Actually, I have been completely shut off now. There is no at the time of writing, right now, there is no rewards programs active on Bancor at all. And I think that is extremely promising, right, for the future of the project. But I think that eventually these chickens come home to roost, and in the case of what we're struggling through right now, it was extremely large, whale addresses that had farmed BNT for a very, very long time, and who may have set up the short positions on FTX before dumping massive amounts of the token into the market, and lining up further withdrawals after that fact. So really, I think that what I'm trying to say is that I'm still 100% confident in the IL protection paradigm that was set up. I just think that we never handled it with skill, because from Bancor. From the Bancor protocol's perspective, the IL liabilities of the protocol and the liquidity mining emissions are basically the same number. There's no way to distinguish between these two different inflationary effects of the protocol. So it's really been, I'm kind of looking forward to seeing it, seeing it fight without having its ankle shackled to liquidity mining. I think that the system is, extremely powerful. And I think that the dynamics that we have in version 3 and the type of flexibility that we have, the analytics dashboards that we're building, and everything that we can do to maintain the system is just it's just so positive. And it's just a shame that the liquidity mining sins of version 2.1 had to catch up with us too soon.
So impermanent loss protection on its own is sustainable, but combined with the liquidity mining rewards, it's not something that would ever be healthy for us, and that kind of shows, in addition to the outside players that were mentioned earlier.
Correct. Yeah.
Okay, so I have a couple of questions here from the community, and in no particular order. And I know I have some people that requested. So if anybody has any questions for Mark, please go ahead and request, and I'll do my best to, call you up here to speak in order. But can the cooldown period be shrunk to compensate people looking to withdraw from V2?
Yes, that can be done.
Okay. Let's see here. Somebody's asking for the new wallet address.
Just quick. So I should quickly talk about that, because the cooldown period is actually derived from the impermanent loss protection mechanism, right? So there's Stefan Loesch is much better at describing it than I am. But if you have a look at bit 15, right at the beginning of of that proposal, there's a Monte Carlo simulation that's used to measure a potential exploit, essentially, of impermanent loss protection. And we have no knowledge of any financial instrument that can actually take advantage of that opportunity, but we know that it exists. And it's it's that simulation from which we determined the appropriate cooldown time to make that the value of that exploit go to 0. And so in a moment of impermanent loss protection pause, which is what we're in right now, there's actually no need for the cooldown period. And so potentially that can be reduced to 0, no problem.
Okay, perfect. Let's see. I'm not pre-reading these, so if I am repeating myself, I apologize. But let's see. So when the IL protection gets re-enabled, oh, I just our telegram is active.
Okay,
Okay, let's see.
take your
So
time.
when the IL protection gets re-enabled, will I be able to withdraw migrate my V2.1 protected position as they were before it got disabled with all of the accrued fees?
Yeah, yeah, absolutely. So when we turn the IL protection mechanism back on, everything will go back to how it was. And during this period, if you're not withdrawing, your fees are still accumulating as normal. And so, if you were, I don't know, if you happen to be on holiday or something, or, we're taking a break from crypto and didn't know that, Bancor was pausing this protection mechanism for a little while, and you came back afterwards, you wouldn't even know that it had happened. Your position would behave exactly as it would have, as if IL protection had been switched on the whole time.
Sorry, do users have to migrate from V2.1 to V3? Or is that strictly if they're looking to withdraw?
Yeah, that's just for the time being. So while the protocol is in this state of pause, we didn't want to mess with the V2.1 contracts too much. And so, in order to, if you are in a rush to withdraw and you don't mind wearing the IL, then you can very easily migrate from version 2.1 to version 3 and withdraw from there. But withdrawing directly from version 2.1 is currently not enabled.
Right, but they do not have to migrate. If they're not looking to withdraw and they're happy with their position, they're
Right.
good where it's it, you know what I mean? Like my
Yeah.
assets
Yeah.
are there either way. They
Yeah.
they remain in V2.1.
Correct. If you're comfortable in version 2.1, then you have no urgency to remove your position, then you're totally fine remaining there. There is a question though about some of the, I think we've got about 9 different liquidity pools that are present on version 2.1 that aren't currently present on version 3. And the Bancor DAO is currently voting on those specific tokens because there are known security exploits associated with them, and they require exemption status. So things like USDT and a few others that I won't mention by name because I don't want those projects to think that I'm singling them out. They just have very specific features in their ERC20 contracts that could mess with an AMM, and so require special permission to be accepted into version 3 as a part of this grandfathering process from version 2.1. So those pools will be created, right? I fully expect the Bancor DAO to approve these pools, and that's already being voted on. And so I think that if you really are in a rush, you only have to wait probably a couple of days for the DAO to approve those pools, and then you'll be able to migrate over and withdraw from version 3, no problem.
Okay, perfect. So we're starting to get more and more requests from the community. I'm going to approve. Let's see, Sai, I'm approving you if you want to go ahead and unmute yourself, and I'll do so as we go. I see Thick and Kobe there, so you guys hang in there for a minute.
Hey, Jen, can I go ahead and ask the question? Okay,
Yeah,
awesome. Thank you.
absolutely.
Hey,
Thanks for
hey,
coming
Mark,
on.
thank you. Disappointed but not surprised because a few of us tried to extract something. I mean, withdraw something. We saw 40% impermanent loss yesterday. So I understand how we got
Right.
here. So the question is, how does time help? Right. So I know you said a couple of days. That might be really good news, but how does a couple of days help? Even if it's a few weeks, how does that help? Are we just kicking the can down the road? Because these whales could just wait for a few weeks even, and then this whole thing will start again. And for the community, are we ruffling feathers? All the hodlers with the links and everything. Now, are we going to get them to withdraw because of what is happening right now? So if you can reassure the community, because we want to, we're long-term holders, we don't need to take anything out right now. But seeing what is happening, I'm a little worried if even the long-term holders are going to pull out because of the risk that they are. So how does time help? And how can you reassure the long-term holders we're happy to leave what's there if we know a year or 2 years from now, even if everything is safe, right? But if this can happen in a few weeks or months again, because the market is just going down, how do we get the confidence that we're okay to leave stuff in there? Yeah.
Mark,
Sorry,
that's okay.
my mistake. Yeah, certainly, it's a very important question. And so there's there's multiple there's multiple avenues that we need to explore here. So one is that we are convinced that some of these very large withdrawals, because they're being taken out in desperation, that they will likely happen without the impermanent loss protection. And so they will, they will be exposed to IL as they would on any other protocol. And once that's kind of off the books, we can start to feel a lot more confident in the fact that we're not going to be, minting a huge amount of BNT in IL protection. And that those short positions, for example, will probably end up being closed on FTX before we have to. I expect those short positions to be closed on FTX before before this comes to some eventuality. But it's not just time, right? We're not just saying that, I didn't mean to imply that all we're doing is kind of waiting and twiddling our thumbs for things to calm down. I know that the article that we put out says that we do want to wait for the market to stabilize, and that's certainly true. There are sort of catastrophic changes in prices happening right now, and it makes the IL protection paradigm slightly more difficult to enforce. But that's not all we're doing. As soon as this call is over, I will be looking back over everything that is built into the version 3 design, and finding out what can be modified there so as to get everything back up and running and performing as normal sooner rather than later. I think one of there are various aspects to the way that version 3 operates, that I've previously referred to as like, well, the dials and levers and parameters that can be changed, that make these things sort of more predictable, more well behaved. So things like variable cooldown times, the withdrawal fee, the vortex burner fee, the amount of on and off curve liquidity, and things like that. And these things result in a very predictable IL cost, and also the insurance premiums that are extracted during normal operation of the protocol. And so I'm going to be using this time to really have a look at based on the current market conditions and the relative volatility that we're expecting, what type of insurance premiums are necessary to make sure that the protocol can chug on without having to wait for things to behave better. I think in cryptocurrency it would be naive to insist that we have to wait for conditions to sort of match our expectations before the protocol can function correctly. That's not what I'm suggesting. What I'm suggesting is that we just need a little while to really model out how we think that the market could evolve over the coming weeks or even the coming days. And propose changes to the V3 settings that will allow the IL protection paradigm to be reinstated. So there's that aspect to it. There's also things like the upcoming proposed liquidity mining incentive, right, that was built into version 3. And so there might be things like I might write to the Bancor DAO personally and ask them to reconsider how they feel about liquidity mining rewards after this event, and if they can alleviate their need of it, then I think that we'll be in a much stronger position moving forward. But yeah,
Yeah.
I'd be happy to get you on a call and we can discuss these things in more detail. But it's not just a waiting for things to get better type of thing. It's a studying what we have and adapting.
Yeah, thank you so much. And I'm sure, the LM rewards are not so much on people's top of mind right now. It's more securing the assets that people have deposited. And,
Exactly.
as long as we can, as long as you can reassure the smaller wallets, the community members that what we have is, safe in a 6-month, 12-month, and I don't know if there's some options there because people are happy to hold. We just don't want to bank run just like Celsius. Now, I'm just worried that once we open up, even the long-term holders are like, you know what, I'm just going to keep it in my wallet. I don't care for the 5%. Interest that I'm going to bet on this one. So as long as you can reassure the community that long-term holders are fine, I think we should be good. And I don't know how that can be done, but like you're saying, there's some options you can think of. So thank you so much, Mark, for your time.
Yeah, my pleasure. I think like one of the other things that I think we need to do better, one of the things that I'm trying to do better is to have a more open dialogue with, not just Bancor community members, but also the TK and liquidity providers. Because I think there is like something, that's not well understood, right, or not widely appreciated, or a little bit mysterious about, the Bancor and how it operates and single-sided liquidity provision and everything else. And I think that during times of like mass panic, which is what we've seen, it can be, it can make us worried, as I don't want to call us custodians necessarily, but as the guardians of the protocol and of the project and of the users that are using it. We just don't want a bad outcome. I don't want to be, please forgive me if anyone's friends with him, but I don't really want to be sort of the Do Kwon of AMMs, where, I was happy to sort of sit by idly or somewhat arrogantly and just pretend that if we do nothing, or if I just deploy more capital to the system or something, that the problem is going to somehow rectify itself. In this case, we really did, we became, reasonably concerned. Like, I wouldn't say, convinced necessarily, but we were reasonably concerned that there would be something like a mass exodus where the overall TVL of the protocol could change by, 50% or more in a single day. And, that type of black swan event, which is what it really looked like we might be heading for, was, scary enough. Like I said before, if there's even a 5% chance of it happening, we should treat it as 100% certainty. And I think that the responsible thing to do was to, cool it down. But I need to, stop and reflect and ask myself, like, why did we end up in that position? Is it really that people are just, that scared of the bear market and everyone's trying to get back to cold storage or something? Maybe it is. I'm not saying that's not a compelling explanation, but maybe there was something else. Maybe there is, someone spreading, misinformation, or maybe something I said was misunderstood, or whatever it happens to be. I would like to know how we ended up here, and so that we can avoid that in the future as well. I think that that's also going to be a big part of the recovery plan, is learning what happened, like what was that breakdown in communication that led to people thinking that that they had to flee from the protocol en masse. It is mysterious to me, and I do want to investigate it. And I want to stop it happening again in the future. Not everything that we do on with regards to protecting users is necessarily technical and smart contract based. I think another big part of it is just educating people and making them feel confident and and secure. And I think that part of my role was not fulfilled very well in this situation, and I'm not going to let it happen again.
Thank you, Mark. I think that answered your question. Unless you have another question, I was going to.
Absolutely. Nothing else. Just to be fair, I know we're not, we're kind of losing on the one value proposition, which is impermanent loss. But then to be fair to us, this is the case with any other DEX right now, right? If somebody has to pull out of Uniswap, they would have the same impermanent loss problem. So,
okay, so it's my turn now. Come on.
Go on.
Go ahead, Kobe.
Thank you, Sai, so much for coming up and for asking your question, for your comment. Kobe, if you want to go ahead and unmute yourself now, we'll go ahead and give you the floor.
Hello, yeah, I'm Kobe. I was previously head of risk management for Three Arrows Capital, but I recently got fired. So if anyone's listening, wants to offer me a job, I'm out there. First of all, I want to commend you for pausing the infinite B&T minting in order to manipulate the fictional shorts on FTX. But I got a question which might be more of a suggestion than a question. But as I understand it, Bancor's impermanent loss protection prints new B&T to cover the impermanent loss. So if you have some impermanent loss, the protocol mints new BNT, in order to make the LPs whole, which is a good growth mechanism because no one really likes to lose money. So my suggestion is, why don't you print 10 times more BNT and then give them that as well? So then they get like profits, and you could call it the perpetual profit machine. And that way, any impermanent loss is great for LPs. They make tons of money. I think it's a way better idea than impermanent loss protection. You could have the perpetual profit machine. The winners win and the losers win too. Is this something Bancor could implement? Do you think it's a good idea, or should I write a full DAO proposal? Thank you for letting me speak, and shout out to the Link Marines.
Yeah, okay. So your sarcasm aside, it actually is, the the very thing that you've suggested is kind of the great irony of the liquidity mining campaign of Bancor version 2.1. The impermanent loss protection mechanism, is not free, right? It's paid for by liquidity providers who give up part of their their fee earnings in order to set up something like a mutual fund that helps to cover those things. With the IL protection plus then some, which is what you are what you are joking about, but was actually the reality of version 2.1, and it was a terrible reality, and I was I was very I was very upset and very vocal with other community members, where I said that the liquidity mining thing has to, it really does have to come to an end. And it was heartbreaking to see people think that it is just it's a switch that you can turn on, and I've
got to go. My mom's calling me. Thank you. Bye.
No problem. But yeah, it's thank you for coming on, Kobe. I did appreciate you coming on. But if I can finish that thought process, the ridiculousness of what Kobe has referred to is precisely the design flaw of version 2.1. And I'm so glad that we managed to put it to rest. And I'm really looking forward to a future without it.
Thanks so much, Mark. Thick, you want to unmute yourself? Go ahead. And in the meantime, I'm going to approve the other listeners who have requested to speak. If you could just keep yourselves muted, I'll go ahead and call on you as well.
Awesome. Thanks, Shen. Appreciate the time to talk. Mark, thanks for facing the music in light of all this. Appreciate it. I'm Kobe's intern. And I just had one follow-up question. The version 3 seems to come with the on-off switch. And it seems rather subjective as to when that switch gets turned on and off. I think the only irony here, or I guess the oxymoron, is stable markets within the crypto space. I mean, we just sat through a sideways market for the last month on low liquidity. And that's probably the most stable that I've seen this market in the last 5 to 7 years. So I guess if you could give us some more information on when you feel the exact need to flip that switch off, and what a market condition looks like for you to turn it back on, respectfully. Thank you.
Yeah, no, it's a thank you so much for the question. So yeah, the on-off switch, it's not actually in the contracts. So this required an upgrade, and it was it was something that was insisted on by it was something that was insisted on by people that are very, very close to the project. And as said before, right, we decided that this was necessary to make sure that we didn't get that users weren't massively injured. Now that on-off switch, though, the ability to intervene in an emergency, was voted on by the Bancor DAO in BIP 21, and it is essentially gives the MSIG the ability to take emergency actions when required, as long as it's in the best interests of the protocol and of its users. Now, it is not something that they can just do, at whim. This has to be something that is, legally compliant. And in this case, we had lawyers from 3 different continents make sure that this is something that could be easily argued. And the very first thing that's going to be happening soon is that the DAO will have to ratify this decision, retroactively. But with regards to sort of the market conditions and what is acceptable and whether or not the Bancor protocol can perform well, I think isn't necessarily about sort of sideways action necessarily or anything like that, but more more about the this mass exodus, right? This sort of panic, mass withdrawal that looked like the Bancor protocol was facing. Whereas if that was kind of more spread out, or it looked like it was more more sort of piecemeal, I do think that it would have been fine, even with the price action that we've had to, even with the massive volatility that we've seen over the last few days. So yeah, it's not just about market conditions with regards to price charts or anything like that, but also with regards to the apparent antagonists that we have, and also the number of withdrawals that are all sort of competing with each other. So yeah, it's difficult for me to give you sort of a very clear a clear description of what I think would be normal behavior or what's abnormal behavior. But having something like 50% of the protocol sort of queue up for withdrawal all at once is something that's very, very difficult to tolerate.
No, I completely understand. I think the only part of what you said, not the only, but the biggest part I think of what you said that bothered me the most was the orderly, what I would characterize as I'm paraphrasing your words, but you said it was if the liquidity or the mass exodus was more spread out. I mean, what per your words, you had 3 lawyers from 3 different continents, look over this. I guess, what does orderly liquidity look like within the confines of this protocol? I mean, what are your thresholds that dictate that? Because it still seems rather subjective to me on when that off on switch is flipped on.
Yeah, no, and you're right. It is partially subjection, and I think that it's a good idea to set something up that's a lot more objective, and maybe get the DAO to pass it, and maybe even automate some of this process, so that we don't have to rely on an MSIG authority to save the protocol, but the protocol can save itself. So yeah, I'm inspired by your question. I think that that's something that I need to to get into the DAO's documentation relatively soon.
And I think, if I may, when there's a serious suspicion, Mark, this kind of goes back to what you were saying earlier, that there's a serious risk to the protocol, and the responsible thing is to do something about it. You
exactly.
And you ignore it and you refuse to acknowledge it. That's when you start acting irresponsibly. And the whole thing with Bancor, and it's been from the beginning, has been transparency, and to be honest, it might not be the way of crypto at the moment or the space in general, but it certainly has been, the way of Bancor. So Rick, Mark, give me a second. I just want to give Rick a chance to speak really quickly, if you don't mind. Thanks so much for coming up. And if you don't have another question, I'm going to hold off on our guest. Ether, I know that you're up next. Give me just a moment. Rick, go ahead.
Okay. Yeah, I just wanted to clarify for a lot of the questions I'm trying to respond to on Twitter and such. One of the main themes, of course, is people who had already initiated their 7-day withdrawal. and want to know, are they screwed now? They're not going to get it, and I just want to clarify that you're just kind of left in a position of making a decision, and if you're needing to withdraw, that you can, but it will only be your TKM position, and it would not include any IL protection that you may have had associated with that position. The option B is to just simply wait until we get our runway extended, can turn the IL protection back on, and then at that point you'd be able to withdraw as if nothing was any different. So the really only consequence for those people in that position is, of course, is delay in pulling those funds, which is not ideal, right? That's not nothing anybody within Bancor would like to have be the case. But it is one that's just necessary to preserve, again, everyone's position, including the protocols, as we move forward and get through and get a stabilized market and a longer runway. If there's anything inaccurate I said there, Mark, clarify, but I believe that's what people need to hear, is that they're not screwed. They're not going to get forced out of the protocol, but they are going to be in a position where they got to choose if they're in a position of high L loss, whether that TKN is needing to be pulled out today, or if they can give us the time necessary to make sure we can come through 100% with IL protection once it's re-enabled.
Yeah,
Hey
exactly.
Mark,
It's something that.
I have a
Go ahead.
question. I have a question. Uh, I am a owner of 8 Ethereum Club and I'm going to launch an NFT project. So my question is that because the market is bearish at the moment, so my planning is about to start minting in August 2022. So what's your opinion about the starting of minting an NFT?
I'm not sure that I can offer you advice on that, but I wish you very well with your NFT project, and best of luck. It's a harsh time to be starting a project, so I hope you've got a strong support network, and I'm looking forward to seeing you succeed.
Thanks so much, Ether. VENBA, you're up.
Hey, Mark. I heard you talk about this earlier. You were saying that you wanted to maybe revisit the liquidity mining proposal for version 3, and I've been around since even before 2.1, and I know that that's something that a lot of people were worried about, like you talked about earlier. So I was just wondering if you could talk a little more about that. Like, were you thinking about scaling it back, or do you think this is something that's maybe not needed, period?
I mean, I'm convinced that liquidity mining in general isn't needed. These incentive programs aren't, they don't really represent anything real. The APRs that are reported for all of these things are kind of an illusion in a way. Because I saw a tweet recently where someone was kind of facetiously pointing out that even though their UST has gone to zero, at least they're still getting 18% on Anchor, and for me that kind of really captures the the fallacy, I guess, the farce of liquidity mining APRs and what they actually do. At the end of the day, if your protocol can't work without liquidity mining incentives, it probably just doesn't work. And I do think that our protocol is good enough that it should be able to stand without these things. I think that we became embroiled in sort of that culture of DeFi summer, and it's the thing that everyone was coming to DeFi for, and it served a purpose, and it maybe it distributed the token a little and things like that. But at the end of the day, I think it only does sort of economic and financial harm, and I wish we never had it. And so, with that in mind, I would very much prefer for a token project that's as distributed as Bancor is, to not have any liquidity mining at all. The reason why we've got things like the auto compounder in Bancor is mostly because some of these long tail assets, they do need to find a way to distribute tokens, and things like airdrops and the vanilla sort of liquidity mining campaigns that were popularized by like SushiSwap. They also can do a good job of that, but it can also mean that, there's this massive, selling pressure, which is what I've been referring to throughout most of this call, and which may have driven us a little bit more violently into the situation that we're in. I think in a way we have only ourselves to blame. So yeah, I think, at least winding it down would be my preference. But in general, I don't think that BNT needs to be a rewards token at all. I hope that that's something that the Bancor community considers and takes very seriously.
Okay, I was going to ask too, like, is there a proposal in regard to being able to vote with the VBNT pool token in the future?
Yeah, so this is, I'll answer the question, but I am hoping that we can sort of stick to, the purpose of the call. But I'm very happy to answer it because it's
okay.
relatively easy. No, man, it's
these upcomings.
Yeah, that's fine. It's really easy to answer. So yeah, the BNTKNs are kind of invented to sort of service some of these dual roles, right? So like Vitalik Buterin has pointed out in a previous blog post that DAO tokens and providing liquidity with them kind of puts these the purpose of the token at ends with itself. Because if you are heavily exposed to a DAO token, it's probably because you believe in that DAO and you want to participate in it. But if you are providing liquidity with it, then you're not voting with it. So it's kind of got this this conflict of different use cases. And so with the BN tokens, we did want to create a paradigm where with two different ways of calculating it, that you can provide liquidity with your voting token, but also use the wrapper to vote with the tokens that are in the the Bancor Vault's liquidity contract. And I think in order to demonstrate that, we did want to create that functionality for the BNB and BNT token as well. So yeah, it's something that's coming up. It's just a relatively low priority because VBNT is already sort of a wrapper of BNT, and so it's kind of adding a little bit of redundancy there. But I do think it's a good demonstration, and I think that if we created a contract with these two different vote counting mechanisms, that it would be generic enough that other projects would be able to use it. So yeah, I'm looking forward to getting it done, but obviously there's more work, higher priorities that I need to get out of the way before then.
I look forward to when this is all behind us and we can have an AMA specifically on the use cases for the BN tokens.
But thank you so much for your question. I hope you didn't think that I was browbeating you or something.
No, all good. I appreciate it. And to the entire Bancor team, I know this is a tough time for you guys. So I appreciate you guys taking action and the transparency.
Thank you so much. And I apologize that it happened. And it's I really appreciate the support. This is it's a heartbreaking time for me.
Thank you, VENBA. Sandy, you want to go ahead and ask your question?
Sure. So will you be updating your materials? Like, I'm looking at the Bancor website and it says, can I lose my IL protection? The answer is no. So
Right.
It looks like the answer is now yes, right?
Yeah, that's an extremely good point. We made sure to update a lot of the language on the app, before doing this thing. But yeah, I mean, we only had this was put together in a fairly short period of time, and making sure that we had the planning and conviction to do it was, took a little while. But you're right. It's absolutely something that we should at least, mention that there's now precedent. That if there is a crisis, that to protect itself, the Bancor protocol can disable that. And yeah, we should update our materials with it. It's a very astute observation. And yeah, thank you for mentioning it. I'll make sure that it's done. If not today, then sometime tomorrow.
And I take it it's already in your TOS that you're allowed to do that, basically.
Yeah. So like I said, the how this was done was via the emergency MSIG powers, and so this basically is it's called BIP 21. If you go to our governance documents, you can see precisely what it's what actions it's allowed to take and what actions it's not allowed to take. And so in this particular situation, we used its ability to adjust the impermanent loss protection parameters, in order to stabilize the system so that we can get back to business as usual. So yeah, this is something that was previously DAO approved, and like I said earlier in the call, this decision will need to be ratified by the DAO, and if it's not, then the changes will be reversed immediately. And if it is ratified by the DAO, I imagine that we'll immediately deploy a roadmap with guidelines as to how to reverse the process as quickly as possible.
And do you feel like you have any legal issues here with offering false promises or something along those lines?
Yeah, so we have pretty good legal representation both in Israel, the United States, and in Switzerland. And over the past 4 days, we've been trying to work out precisely what type of intervention would have the least legal exposure. And so yeah, in terms of like what you're discussing there with like false promises and things like that, in general, the courts would have come after us much harder had we not acted. The most responsible, the most ethical thing to do is to intervene in a system before it causes massive injury, and and try and recover from it in a controlled way. Whereas just the hands-off thing, which is I think like this kind of code is law sort of attitude in DeFi, that's actually a lot more dangerous and a lot more legally exposed, because if you could have done something that would have resulted in a better outcome for the users of a protocol, then the courts expect that you should have done it. And if you don't act, that it can be prosecuted for things like reckless endangerment, for example. So yeah, we do have a pretty good legal standing, and we've been navigating these laws for longer than anyone else. And so yeah, I'm very, very confident that we did the right thing, and that we did the legal thing. So yeah.
Cool.
Thank
Thanks.
you,
Great
Mark.
for answering my questions.
Thanks, Sammy, for coming up. Oops.
My pleasure.
Nixon, if you want to unmute yourself in the meantime, I'm going to go ahead and approve a couple more speakers. If you could just keep yourselves muted in the meantime.
Sorry, keep myself muted?
No. You're good to go. I'm going to be
I
approving
understand.
new speakers. So if they could in the meantime, yes.
Okay, thanks, Jen. Thanks, Mark. As someone who's still familiarizing himself with DeFi protocols, could you explain just why a protocol should have impermanent loss protection instead of not?
Oh yeah, for sure. Okay. So impermanent loss is something that I'd say that requires a fairly good understanding of the action that the user is taking. And in general, most AMMs don't really do much to ensure that users have that understanding before allowing them to commit funds to the protocol. And this isn't just true of AMMs, by the way. You can make this the same argument about sort of leverage protocols and options protocols and whatever. But in sort of the traditional world, there would be some sort of licensing scheme or some qualification that someone has to produce that would give you the confidence that they are equipped, right, to use the tools that you're giving them, and that they aren't going to hurt themselves with it or hurt someone else, right, or hurt the entire industry. Now, obviously, that's not always a good assumption. Just because someone has a qualification or a license to perform certain financial actions doesn't mean that they're going to do it well and they're not going to hurt themselves. But whatever. I do think that there is an ethical obligation for DeFi protocols that aren't doing anything to ensure that users know what they're doing and shouldn't, right? I think this would be a huge invasion of privacy. Then we have to assume that they don't, or at least you have to approach that approach the design of your protocol with that in mind. That some 11-year-old or something with their parents' credit card and a MetaMask wallet might try to do things on your DeFi protocol. And I think that with the level of sophistication, understanding that we have of how our AMMs operate, and what markets do, that we should be able to build something that is intelligent enough, that is self-aware enough, that there is no intrinsic risk, right, to the user. Now, in a granular sense, this is never going to be true, and this is something that I've had to respond to many times. So for any one specific liquidity pool, you will never know what the possible impermanent loss ramifications are. But for a very large collection of them, and especially over a very large protocol, these things do become more predictable, and we're getting better at predicting them. And I think that that's kind of the answer that I wanted to give you. I think that there is or there should be an ethical obligation to the users of your protocol, that if they are going to interact with it, that it's not the user that's taking on the risk, but the protocol that's taking on the risk, or that it's the protocol's responsibility to manage that risk. I think that it's much easier to create a protocol that says all of the users' actions be on their own head, and I don't think that there's anything especially challenging or noble about creating such protocols. When I was in Barcelona at the Avalanche conference, I presented a talk where I was kind of sort of trying to describe a rubric that I'm creating, that sort of is trying to work out how valuable a protocol is, or how useful a protocol is, based on the intelligence level of the person using it. And because you can't sort of gate your protocol based on intelligence, because we don't do anything to learn about our users before they interact with us, you can sort of assume that you're going to get this spectrum of naive to highly educated. And if your protocol is built in such a way that it favors people that have more information, maybe insider information, or just like a better understanding of how to use that protocol, then what you can do is set up a system where the educated cannibalize the naive. And I think that that's kind of terrible, right? I think that people should be able to feel safe, right, interacting with protocols, and that they don't have to study, or they don't need to go to university and get a finance degree, or they don't need to stay up monitoring their positions, or have a small staff running actuary tables for them, or it's just I think that expectation that we have, that DeFi users should be financial experts, is kind of sad. And I think that that's why impermanent loss protection is something that's important to me, and it's something that will always be a part of the way that I think about AMMs and the design of DeFi in general. But I know that was a little bit of a long explanation. I'm sorry if I wasted your time, but
that's all right. I'm just gonna I wanted to break in and try and digest a little bit of what I'm hearing here. So forgive me if this may sound unkind, but basically you want to protect dumb investors, or malinvestments, people who may not know what they're doing or have the requisite experience or knowledge to avoid that kind of risk. But then it also sounds like you're saying the protocol should be the one to be responsible for that. So it's sort of socializing that risk, or socializing those losses. Is that way off base here?
No, that's actually pretty close. It's not necessarily socializing the losses, but certainly, socializing the risk in the same way that like an insurance like an insurance company would. Something like State Farm, for example, like people that own insurance policies, on their houses, on their cars, or whatever, they're not necessarily, there is no expectation from them that they would understand how insurance works. And what happens behind the scenes, with the way that special insurance vehicles are created, and insurance-linked securities are created and traded. All of that stuff behind the scenes is what you want to automate. right? So what you want is the customer, right? The person who is doing the thing that generates the value, right? Which in this case is, the purchasing of an insurance contract. That person doesn't need to understand what an insurance company does. And I'm stipulating that you don't need an insurance company either, because the whole point of DeFi and smart contracts is to alleviate the middleman. And I do consider these kinds of sophisticated financial constructs to be incumbent middlemen. And that's the ambition, right? Is to do away with the need to have a human there at all.
I think
But
if you want to, we can continue like the actual definition and breakdown of impermanent loss maybe on another call, Mark, unless you want to continue with that. I'm just thinking that we have quite
I
a
think
few questions that we need to answer to address like the actual current market condition update with Bancor and the impermanent loss protection.
Sure. Just briefly, and then I'll get off here. I wanted to establish the idea here that if somebody were to create a new protocol from scratch here, that the prerogative of setting up impermanent loss protection would be to instill confidence, basically to obfuscate the risk away from the user and put it on the protocol. Is that basic assessment correct?
Yeah, essentially, that I think that the responsibility of the risk management should be that of the protocol, not that of the user.
Is there then a tertiary risk created by the user base not understanding that the protocol is assuming that risk?
Yeah, absolutely. There
As
is.
we're seeing here, I think, is maybe what I'd say.
Yeah, I think that's a totally legitimate criticism. And yeah, it's you're right. And it's something that I should do something about.
Okay, thank you so much for your time. Thank you, Jen. Thank you, Mark.
Thank you, Nixon.
Thank you so much. I think maybe I'm mistaken, but are we kind of overlooking the liquidity mining rewards and everything else in all of this? Because I don't feel like it's necessarily just the impermanent loss protection.
Yeah, I think. Well, I mean, what Nixon was challenging me on, I think, was whether or not impermanent loss protection is even an ambition worth having. And this is, I'd say that he and I do represent opposite sides of the aisle a little bit. I do think that there is this kind of there's this opinion, this this attraction to sort of the cutthroat best your opponent attitude of finance. And I think that that's not necessarily wrong, or it's not even the fact that it's unethical, for example. If we assume that everyone that's agreeing to participate knows what they're doing, which, as I pointed out, I don't think is necessarily a good assumption. But let's say that it is. I think it's okay that if you are smarter or better or more clever, if you have some advantage or some edge, that you should feel that there should be ways for you to exercise that that relative privilege over someone who is in competition against you. Nothing wrong with that, right? I am a capitalist, and I do agree with I do agree with it, but the approach that I'm taking is that we can't assume that all of these people that we're attracting to DeFi do consider themselves right at in competition with each other, or that they are trying to best each other or something like that. Certainly some of them are. But whenever I attend some of these podcasts and things, I'm often asked where are the next billion DeFi users coming from. And I don't think it's going to be from, universities. I think that if we are sort of, striving for this, this decentralized, vision of the financial markets, then we do need to sort of, appreciate that the financial instruments that have been developed in the traditional world, they just aren't appropriate for that sort of scale. There are people that do study for many years to learn how to use them correctly. And I would rather, in the same way that we have, taken people that are very, very clever and use their skills to develop, things like, like autocorrection, dictionaries and things. The finesse should be in creating a protocol that is smart enough for the user so that the user doesn't have to be smart on their own, or at least that's my attitude.
I understand. Thanks for clarifying. Crypto Gent, you want to unmute yourself? In the meantime, I'm going to go ahead and approve some others.
Yeah, I had a question. So I've had most of my net worth parked in DAI in V3 of Bancor, and I recently withdrew, and I have that 7-day cooldown period. I just wanted to know what to expect when that 7 days is over. How much am I going to get back, and what's going to happen exactly? And if it's possible for that 7-day cooldown period to be removed at all.
Yeah, absolutely. Yeah. So you can actually cancel the 7-day withdrawal period whenever you like. And so that's still available for you at the app. Just be aware that means that you are still in the protocol. The way to get the maximum value for your withdrawal is to wait for the impermanent loss protection to be switched back on. Because if you withdraw right now, even if you had previously, began the cooldown, then whatever IL your position has experienced, you will be withdrawing with, unfortunately. But this is something that maybe you and I can talk about. Maybe, I don't know, in private or something. I think that I may be getting dangerously close to giving financial advice, which is something that I can't allow myself to do. But what I can tell you is that if you are, if you're relatively patient and allow us to turn the IL protection mechanics back on, that you'll be able to withdraw the full portfolio value of the DAI that you deposited. Whereas if you are withdrawing before we turn it back on, whatever IL has been experienced in your position, unfortunately, you'll have to wear. But yeah, you can follow up with me and we can talk more about those details.
So to sum that up, at the end of your 7-day withdrawal period, you can either confirm your transaction, at which point you're going to have to suffer the impermanent loss and pay that, possibly 0.25 withdrawal fee, which is yet to be determined, or you can cancel it, stay within the protocol and continue earning your fees and wait until the impermanent loss protection is kicked back in.
Okay, is there any way to see what to expect in impermanent loss before that happens? Because it seems like you just have to withdraw, and that's when you find out how much you got hit by.
Yeah, that shouldn't be true. I had a meeting with the the app design team over the last few days, because we had to change some of the language and stuff there. But one of the things that I pointed out is that breakdown should be visible at all times, right? So as you start the withdrawal, as it's completing, at any time. And it's something that is very easily revealed on the smart contracts. So I think that this was just a small design oversight. But yeah, I will be rectifying that. And if you want to, if you would like to know, today, I can provide you with like the tools to measure that directly without too much difficulty.
Yeah, that'd be great if you could give that to me.
Yeah, my pleasure. No problem. Just send me a DM after the call, and I will do my best to put those tools in your hands.
Okay, appreciate it.
Mark, quick question in regards to that. Thanks so much, Crypto Gent. I was under the impression, you can correct me if I'm wrong, that the amount of IL suffered between, like on a position within that 7 days is going to vary. So to show it in the beginning and to show it at an end, like at the end, would be inaccurate.
That's correct. Yeah, and so what I've asked for is for people to be able to check it at any time, right? So as it can never project for you at the end of the withdrawal period what your breakdown will be. But what it can show you is, like, if you were to withdraw right now, what would it be? And I think that's still useful information.
Okay, right then and in the moment. Perfect. Thanks for clarifying. Albert, you want to unmute yourself?
Can you hear me?
We can hear you.
Okay, great. I'm just wondering, for anyone who hasn't migrated from V2 to V3 yet, in theory, if they had the 100 days in V2, then they should be they should have the impermanent loss. But obviously, now that the protocol is all migrated to V3, I'm assuming there's got to be people that haven't migrated their position yet, like me included for one of mine. What would you say in terms of in regards to that kind of scenario where to withdraw, it would still have the 7 days, I believe, but then yeah, it's the impermanent loss in regards to that scenario. Thanks.
Yeah, no problem. So yeah, the dichotomy that you're referring to is that on version 2.1 you have to, your insurance vests for 100 days, and if you've got a position on version 2.1 already, then when you migrate to version 3, that you would have to complete the 7 days again, right? So it's like, imagine you just finished 100 days on version 2.1. Are you saying that it's not fair to have to do 107 days?
I'm just saying that I haven't, for one of my positions, I haven't migrated it yet. So if I was to withdraw it, like I have an option either to withdraw it or to migrate it, basically, right? So.
Yeah, well, actually, it's one and the same, because in order to keep the logic relatively tight, the direct withdrawals from version 2.1 are currently disabled. So if you want to withdraw in a hurry, you need to migrate to version 3 first. But what I can say is that until the protection is resumed on on both protocols, it's actually totally fine to just leave your stuff in version 2.1 until it's switched back on, or you can migrate to version 3 and withdraw from there.
Right. Okay. I'll definitely think about that, and I'm sure there's a lot of people that are in the same position, so that helps. Thank you.
I'm in the same position if it's any consolation.
Okay, great. Yeah, because I mean, it's just the current predicament that people might be in, right? So, great.
So basically on V2.1, you have 3 options. You can stay on V2.1, you can migrate to V3 and stay in the protocol and earn the trading fees, or you can migrate and you can withdraw. Mark.
Yes, confirmed.
Perfect. Okay. Thanks, Albert, so much. Crypto Alchemist, if you want to unmute yourself. And if we have any other listeners that want to ask any questions, please do go ahead and request.
Hi, everyone. Hi, Mark. Hi, Jen. Thank you for accepting. Mark, I want to thank you first for doing the emergency thing, even though you said the situation of the whole Do Kwon and what the whole crypto space went through, and what we experienced and what cascading events it had from there. Since we're like an infant baby in the realm of DeFi, I believe your parental observation as far as deciding to do this kind of a act upon the system was somehow beneficial to the users and the community itself, even though people might not like it right now, especially because of the whole cascading bear market we're in. But my question was mainly in regards to, well, I believe the bear market we're seeing mostly is because of the tools that DeFi put in the hands of whales, of being able to manipulate the market through taking loans, whether collateralized or uncollateralized, and doing expert financial activities through shorting, through FTX, borrowing through another platform, and how we've seen it. I was wondering how we can manage the type of actions whales take on platforms, how we can minimize it, how we can still have them in the protocol, but give them less power even though they have so much money.
Yeah, it's obviously it's a huge issue. Again, like I'm not sure that it applies like specifically to the purpose of the call, but I'm very happy to answer it anyway because I think it's fascinating. One of the things you pointed out, I think I dropped out for a second there, but was I think like sort of risky borrowing practices, like massive leverage and things like that, and we've seen so many examples of this go like horrendously wrong. Like the GME short squeeze was, from not just one, hedge fund, but many, sort of overshorting that position. And, things like the nickel short just recently and so on. Whether or not there is too much whale influence in DeFi, I would say is a point of opinion, but I still think I agree with you. In general, DeFi protocols are dominated by whale accounts, and so I think the easiest way to sort of decentralize that capital and get more players in, which is going to certainly make for a more stable environment. I think is to address the costs of participating. For better or for worse, and for the purpose of this conversation, it's almost certainly for worse. Ethereum has become sort of a whale chain. It's very expensive to interact with, and it's unless you've got significant capital to throw around, it doesn't really make sense to even participate in DeFi in the first place. And so if people are paying $10 or even $5 a transaction, I'd say that alienates a lot of people, and that's probably an issue. There might be ways like where things like the layer 2 scaling solutions, which are significantly cheaper to interact with, that some of that more small fry capital can participate and better decentralize the system. But it takes a lot of small time participants together to sort of add up to the type of control that very wealthy individuals or very wealthy organizations have. And you're right. I've seen just earlier this morning, I think there was a vote on a Solana DeFi protocol to take control of a whale address on a lending protocol that basically can't be effectively liquidated. And that's a problem. That if that might not have surfaced if it wasn't under whale control. I've also remember there was an interesting effect on Uniswap v3. On a Uniswap v3 pool, where someone was providing liquidity in a token. I can't remember exactly what it was. I think it was IDX or something. And their liquidity moved out of range. And I think that they were trying to be supportive of liquidity for the token. So they took their liquidity out and sold some of those tokens for I think USDC in order to put it back in range. And unbeknownst to them, because they controlled the such a significant proportion of the overall liquidity on Ethereum, they ended up tanking the price by 25% in a single transaction. So it's not even that people are doing stuff deliberately. I think that there are deliberate nefarious actors. I think that there are people that are accidentally doing something wrong, and then I think there are people that are just taking on like catastrophic risks. And then sort of leave other people holding the bag. I think one of the most disgusting quotes that I heard recently was from 3 Hours Capital. And it was something to the effect of, if I owe you $1 million, that's my problem. But if I owe you $1 billion, that's your problem. And it's those kinds of attitudes that I think are kind of rocking the world of crypto right now. And it's a huge problem. What to do about it, right? So making DeFi protocols more open, cheaper to use, and safer for people that might not have that type of that type of tool set available to them or that type of background. I think is a huge step in the right direction. I don't. Just like I think Nixon, who was up here before, was challenging me on. I think that one of the ways to help take some of that whale control away is to take their advantage away, right? And build protocols that don't necessarily allow people with more capital to benefit disproportionately from that capital that they have. So yeah, it's going to come down to things like blockchain design, but then also protocol design, and then risk management, LTV ratios and other things on lending protocols that basically shouldn't be there. But yeah, it's a long-winded way of saying that I think I can identify the problem. I don't have any really good answers for it. But I think developing protocols that regular people can interact with without much education and without much capital is a really good place to start.
Yeah, yeah, generally that's what I believe as well. And what what my concern has been, and I'm not a big pocket guy, but what I've been done, I've been experimenting in different aspects of DeFi, and what I've learned that is, like you said, the liquidity mining at the beginning, bringing all the greed first to the DeFi, and eventually DeFi being a perfect tool for such whales, wallets, or bigger pockets to be able to take advantage of the little money that each individual person has. And if you collect all of those, then that itself will be a whale wallet, and they can take advantage of that and twist and manipulate the market however I want. I was to be frank, I was going to share something with Glenn about 2 days ago about the situation on uh, a wallet address that was playing with Link and shorting it on Binance and doing all those type of math and financial stuff on it. And I wanted to share that with Glenn, and I wanted to be, hey Glenn, let's make sure something on Bancor is on there, that we restrict the manipulation of whales, or not even like not restrict them financially, but restrict them in a timely manner. Let's say we take the objection of the money out, but we bring an objection of the time in. So if we factor a time in the equation, maybe it will draw down the possibilities of these kind of moves slower downer. That's kind of like my thought.
Yeah, it's there's not just one approach that we can use. I think that it's going to take it's going to take a diversity of approaches to solve for good. But it's very good of you to be thinking about it. I think it's an important issue, and yeah, I look forward to seeing some of these ideas come more out into the open.
Thanks so much, Crypto Alchemist. Appreciate it. Thank you, Mark. Frog Monkey, if you want to unmute yourself.
Yeah, hey Mark, hey Bancor team. First off, just want to say thanks for hosting the space. It takes a lot of guts to make a decision like this and then just, open it up to crypto Twitter. Just for some context, I don't own any BNT. I just kind of heard about this through Twitter, and I actually have an interesting governance question, more so than sort of the protocol itself, and just want to get your perspective on it. So, reading the Medium post, to my understanding, the reason for this halt was a massive sell-off of BNT token. And it says like the need to pause IL protection is a result of the recent sell-off reward emissions that were accumulated over the past 18 months. And so my question is, I understand that through I think it was BIP 21, the multi-sig is empowered to make these certain sort of executive decisions pending a veto of the DAO itself. But do you think it sets a dangerous precedent when a core team is able to pause certain protocol features to support the token, really like the token price, right? Because if the sell-off sort of continued, God knows where sort of BNT would be sitting at the end of it. But it seems like this decision was made to protect sort of the token price, to be honest. And so I wonder, does that kind of, do you think that kind of flies in the face of the ethos of decentralized protocols? And do you think that could introduce some regulatory scrutiny if a team makes a decision to support a certain sort of token value. And if I'm wrong in any of these assumptions or these sort of conclusions I've drawn from reading the Medium post, please let me know.
Yeah, it's a really, really excellent question. And so one thing that I should say very quickly is that the decision wasn't to protect the BNT price. It was to protect the Bancor protocol. And it wasn't the case that we're seeing something being sold off and we're trying to stop it being sold off, because you can still sell your BNT, right? You can sell it on you can sell it on Binance, you can sell it on Coinbase, you can sell it on Bancor, right? Nothing we've done prevents that. What we were trying to do was prevent a massive amount of BNT minting in sort of a cascading effect that would effectively mean that no one is getting that would effectively injure, right, the entire community that's built around the protocol. So yeah, it's not about BNT price. It's just about the functioning of the protocol. And it's interesting in Bancor's case that the price of the token and the functioning of the protocol are sort of so intimately related, similar to something like Olympus DAO, and the way that the Ohm token is intimately related there, and there are a few other examples. But yeah, it's not the case that we are insisting that BNT should have a certain market cap, or it's supposed to be valued at a certain rate or something like that. It's more the fact that as the price changes, it has an impact on the way that the protocol functions, and more importantly, as BNT minting occurs, that has an impact on the functioning of the protocol. And so yeah, with regards to sort of regulatory issues, I can't imagine there being any specific problems there. Because the alternative is just letting the system essentially move into sort of meltdown, and we already know that benefits no one, and that there's no there's no ethical high ground or anything to be had there. I promise you that the lawmakers want what's best for everyone, and that if we do the responsible and ethical thing, that's generally in line with the expectations of the lawmakers. So yeah, I'm 100% confident in this case that we did the right thing.
Okay, so quick follow-up question then. I guess like my gap in my knowledge exists where like I don't quite understand how the value of BNT affects the security of the protocol itself. Can you give me mainly like a quick explain like on five of how those two are connected?
Yeah, absolutely. So in the system. So in the situation that we were facing, or beginning to face a couple of days ago, which sort of started this whole process, we were looking at a situation where so much the liquidity from the protocol looked like it was exiting, and was going to exit all roughly at the same time. That by the way, that because there had been a large amount of BNT sell-offs during the leading up into this period, we have two compounding factors. So one is that because there's a diminished BNT price, that would mean that there's going to be a slightly elevated impermanent loss on each of the pools. And because the BNT price is lower, it means that there needs to be more BNT created in order to make liquidity providers whole again. And so as the first liquidity provider does that, the liquidity of the system is impacted a little bit because they've made a withdrawal. And then as they, because of the current market climate, it's very, very likely, almost certain, that the liquidity provider is going to want to sell their BNT immediately, right, at spot for some other token, probably a stable. Whereas, in other times that turned out it wasn't necessarily a good assumption, right? I've seen many occasions where liquidity providers would withdraw and keep their BNT. So because the price was diminished, because IL was relatively high, and because that would result in minting a lot, in minting extra BNT, and that there are very many, potentially cascading withdrawals in the queue. then as each one of these kind of dominoes falls over, then the next one has to, as each domino falls over, that results in further price depreciation, more IL, and therefore more BNT minting, and so on and so forth. And as this, is taken to its logical conclusion, you end up with something, very, very similar to, for example, the Terra Luna ecosystem. And if you've got a completely worthless token, it's actually not at all helpful to make markets with it. And so, the actual utility of the protocol and its proper functioning is contingent on BNT not having, like a high price necessarily, but having a price, right? A reliable price. And so if there are, way too many BNT tokens in existence, it's just very, very difficult to bring the protocol back to proper functioning. And the other thing is that people would give up on the system, right? If we let something like that happen. And so, for many reasons, right? And I know that we are going to take a hit with regards to confidence after today, and I'm devastated that that's the case. Really, like I'm heartbroken that that's true. But I promise you, the confidence in the system would have been reduced to nothing if we'd let the system sort of slide into trillions of BNTs or something like that. And if someone doesn't, if people don't have confidence in the system, no one's going to use it. And so it ceases to be a useful protocol.
Right, makes sense. One final question, and then I'll hop off and give someone else some space. So would you? It sounds like it was a protocol design flaw that was susceptible to this sort of extreme condition. Do you I'm assuming the team is going to probably do a postmortem after this and maybe introduce new mechanisms going forward to protect against such events happening in the future, right?
Right, absolutely. And I think this is something that I wish I brought up earlier in the call because someone just asked me about it. I think what was lacking from this, from Bancor version 3. Is something like a withdrawal circuit breaker, if you like. And, there are other protocols that have this, and we certainly should have ours, that, essentially limits or somehow better manages the amount of liquidity that can be withdrawn in very, very quick succession. And what I mean by that is not prohibiting people from withdrawing, but say if someone is withdrawing on the same block as you or something, that your transaction is reverted and you have to withdraw on the next block or something like that. So these kinds of mechanics were absent, and I would say that was a design flaw. And it's luckily I'd say that it's relatively easy to to set something like that up.
Thanks so much, Frog Monkey.
Yep, thank you.
Yeah, absolutely. Mark, we have been on for an hour, 45 minutes. I have a couple more questions. If you don't mind, I would love to.
Of course, I'll be here as long as needed.
Okay, so circuit breaker was mentioned to me, and you touched on that. Pacing out withdrawals.
Yeah.
Is that something that we might look into in the future? As we kind of get back into the IL protection, or just in general?
No. So the reason I brought this up is because it's something that I've been, thinking about as we've been, preparing to protect the protocol from this event. So the first thing that you have to do is think, what was this shouldn't have required, an intervention. We have these smart contracts that have, are perfectly capable of managing themselves. You just need to make sure that there is a smart contract there that's programmed to manage it. So I think that distributing withdrawals over a wider time period is something that can be automated. I think that there are other sort of relatively relatively conspicuous bottlenecks that we can put in there, like some sort of some sort of disincentive to sort of hop in and out of the cooldown contract really frequently. So like one of the things that's come up pretty often, including by like Wyon, by the way, is that when we explain how the cooldown contract works, that that they said, oh, but so what's to stop me from just being in cooldown from day one and then leaving it for 7 days and then just withdrawing from whenever I want? And the response is you can do that. But the problem is that because you're not earning any fees while you're in the cooldown contract, you don't really have any profit motive to interact with the protocol at all. I mean, you're welcome to do it. It's not exploitable, but you wouldn't really be benefiting from it. But if you cancel your withdrawal, then all of the fees and things that you've previously missed out on are returned to that position. And so one of the things that I've realized is that a lot of people are likely just sort of queue up a very large number of these withdrawals that would start to mimic something like a panic state. And even if there isn't one. And so this is probably something that we need to address so that the protocol has much better visibility on what the actual sentiment is like with regards to liquidity providers and their ambitions to exit or leave. But you could even make the argument that we may have overreacted in this case because maybe that's just what people were doing. Maybe they had just decided that they wanted to sort of sit cozy in the cooldown contract so that they can leave on at a second's notice if they chose to, and that's certainly likely. But after scouring Twitter and some of the message boards around the internet and things, I became very convinced that that's actually not the case, and it was a true sort of panic event that did actually warrant some intervention. So what I'm saying is, if that panic is what led us to getting to this kind of point of fragility, then we should have a mechanism, an automatic mechanism in place that prevents those types of snowballing situations from appearing in the first place. So if that means spreading withdrawals out, then so be it. It doesn't even have to be spread out that far, in my opinion. But yeah, it's something that I'm thinking about. I haven't yet decided precisely what the design will be, but everyone should be pretty confident that when we unpause the IL protection mechanism, that there will be something like that in place before we do.
Perfect. Thank you. McCamick, you want to unmute yourself and ask your question?
Yeah, I was curious, are there any conditions of V3, whether it be like TVL, trading volume, percentage of protocol owned BNT, market cap, that could prevent this kind of vulnerability or threat in the future? Is this a growing scaling problem, or is there a fundamental rework that's required somewhere?
Yeah, it's a really good question. It's not a fundamental rework. I think that there are some with respect to the last question, some things like getting spreading out the withdrawals, but also things like the liquidity mining issue, which is something that V3 inherited, right, and tried to rectify. But we're still sort of carrying that weight from the version 2.1 protocol. But yeah, these I wouldn't say that they're necessarily growing problems because version 2.1 already had these kinds of issues. We just didn't get a chance to ever see them play out because we didn't have events as catastrophic as the ones that we've seen over the past couple of days during its tenure. But yeah, version 3 is already better at handling them. I just need to make a couple of minor changes, I would say, to the way that withdrawals are handled, and I think that we'll be right as rain. It's not, I feel like a lot of people are maybe suspicious that version 3 has some sort of critical issue or something built into it, and I just don't I'm not convinced that that's the case. It really was sort of a behavioral a market psychological happening that I think put the protocol in this situation. And now that I'm aware of it, it's going to be fairly easy to build in some design features that protect against it. But yeah, I wouldn't say it's growing pains, because version 3 is already so much better than version 2.1, and I have every confidence in its future. I do consider this a black swan event, and the fact that we've experienced it and are going to live through it, I think means that we're actually going to come out, one of the few projects that's going to have the benefit of that experience behind it. And so, yeah, I think that what doesn't kill you makes you stronger. In this case, I think the version 3 is already pretty strong, and it's going to get a lot better afterwards.
McCamick, did that answer your question sufficiently?
It did, and if I may, a follow up.
Go ahead.
I completely agree that the liquidity mining rewards were more of a crutch and kind of a stunt to kind of like allow a lot of these AMMs to kind of practice and play around with features. So I agree that it wasn't a good thing, but I'm really curious more precisely, like what are the hangover effects that really cause this? Is it just a large total supply? Did it cause a lot of centralized holding of it, or what specific feature is it that's actually the problem here?
Yeah, I got you. Yeah, I mean, somewhat ironically, the problem is impermanent loss, right? The problem is that there has been accelerated, you might say unnatural, selling pressure on BNT because version 2.1 created so much of it and gave it to to so many people. And that means that, in general, all of the non-inflationary tokens really seem to sort of just move together. And, you can have a look at, there are so many examples of this, and I don't necessarily need to list them. But, there's generally sort of a range within which all of these different DeFi tokens and, cryptocurrencies and meme tokens and everything kind of start to look like each other. They might be volatile relative to something else, but relative to each other, they kind of look the same, or their price charts can generally look quite the same. I think the same would have been true of BNT. And in fact, because of because of that BNT is paired with everything on the network, it actually kind of hugs their price charts, in quite an intimate way. And so when you've got something that has that kind of that type of index effect, to inflate it and push it off, the average means that you're kind of almost deliberately introducing additional IL into the system. And in the blog that is attached to this tweet, I point out that if you are doing this, right, if you are distributing liquidity mining rewards to users who are then using that to sell for some other token, which results in more impermanent loss, that all you're doing is setting yourself up to mint even more BNT at the time that the withdrawal is processed, because you've kind of done everything in your power to exacerbate and stress the impermanent loss of the system before before giving users a payout for it. So yeah, it's not the case that there wasn't enough liquidity, although honestly I would have preferred the protocol be much larger, with more a greater diversity of tokens, and I think we would have had them, had did we not have such stringent security practices with regards to which ERC20 contracts we can support. But yeah, the protocol's liquidity could have been a lot higher, and in that case, the circulating supply doesn't even really matter, right? There's something called the BNT funding of the protocol, which is the protocol-owned component of that BNT. Which is relatively price neutral in terms of inflation, and therefore doesn't really impact on the IL. But yeah, the liquidity mining doesn't have that property, and it really did impact the system in quite a big way. So yeah, it's I think that is the thing that has led us to this point in time. I don't know. Did that answer your question, or do you think that this is something you want to push a bit further on?
No. It sort of clicked. The inflationary presents a lot of selling, which worsens the impermanent loss protection. Right. It makes. So I appreciate you answering, and I think I really like this design of an AMM way better than what I've seen in the past. So keep it up, guys. I appreciate what you're doing.
Thank you so much, and thank you for your patience and your support. I really appreciate it.
Hey, if you need any developers, holler.
Yeah, man. Dude, send me a resume. I'm looking for developers.
Thank you so much, McCamick. Appreciate it. Ariel, you are up. You want to go ahead and unmute yourself?
Yes, thank you. Do you listen me? Okay?
Yeah,
yes, we can hear you
fine.
just fine.
Hey, hi, hello. Hi, hello, Mark. I just have a couple of questions. I don't know if you answered this before, but wanted to ask. But firstly, thank you for taking the time and to answer all these questions. But firstly, I mean, what type of pools do you have, like the permanent loss protection? All the pools are, or just some type of pools? Yeah.
Sure. Yeah. Okay. So the answer is slightly nuanced. On version 2.1, most of the pools, I think, are what we call whitelisted, which means that they have that impermanent loss protection. But on version 3, as a requirement, all of the pools have impermanent loss protection. So any asset that's on version 3, and I think we're up to something like 149 or something tokens, all of those are automatically protected against impermanent loss. But on version 2.1, there's still this permissionless way that you can create a liquidity pool if you aren't asking the DAO to insure it for you. And so some of the liquidity pools on version 2.1 don't have impermanent loss protection. And so if you go to the app on version 2.1, I think there's a little blue shield next to all of the pools on the earn page that are insured, and then the pools that don't have that little blue shield aren't. And I think that's the best way I can
right.
Yeah.
Okay, awesome. So, and what type? This is the last question. So what I mean, how much of a loss should we expect on regards of like withdrawing without the protection?
Oh yeah, that's a really good question, and it changes. It changes based on which assets you're talking about, and also the specific parameters of the pool. So even in protocols like Uniswap v3, so they don't have any impermanent loss protection at all, and that doesn't necessarily mean that users are going to suffer a large amount of impermanent loss either. So if you happen to choose the right token pair, and you provide liquidity into the right range, it's actually very, and people pull this off all the time. They can make quite a decent return for themselves and withdraw without losing anything. And the same is also true of regular constant product market makers. There are some token pairs that just don't seem to experience impermanent loss very much, and so being long the fees is it can be a very rewarding strategy. But then, there are these unpredictable token pairs where they will suddenly just move away from each other very, very quickly. I think one of the most familiar examples for a lot of people who discovered sort of DeFi during DeFi summer and bought a lot of Ethereum, and started providing liquidity on SushiSwap and Uniswap and everything else, is that when Ether made that run from like $80 to like $4,000. A lot of those liquidity positions ended up with, very, very small amounts of ether left, and people were sort of heartbroken about how much money they'd end up losing. But I think that one of the things I would encourage you to do is to, if you've provided liquidity before, is to go to il.wtf, and you can put in whatever Ethereum address you want, and it will measure the IL that's been associated with the liquidity providing activities of that address over its entire history. So that's a really good place to get started if you want to learn more about it. But yeah, it's a complex topic, and there's no single right answer.
Thank you. Could you repeat the webpage, please?
Yeah, it's IL. So the letters I for like I for Ian and L for Larry. WTF, like what the fuck.
Okay, great. Thank you very much, Mark.
You're very welcome.
Okay, Mark. It looks like we have one more request. Ariel, if you want to, also I can message you some information on impermanent loss and impermanent loss protection.
Thank you, Jen.
Yeah, absolutely. Okay, Sharp TX. Mark, I also spoke too soon because we have more requests coming in, so bear with me.
Yeah, my
no
question
problem.
is, what does the team have planned to kind of restore some faith in the protocol? Given that this decision obviously affects some, quite a bit, where really, I mean, if let's just say I'm in Link, and having the market correct, like Link shoot up, is only going to make this worse. It's only BNT going up. So what exactly is the plan to get some more confidence in the protocol?
Yeah, 100%. No, it's a really good question. And so one of the things that we have done previously is cooperate with market makers to help us make markets on like Coinbase and Binance and everything else. And so I think driving some more liquidity into the centralized exchanges even during a bear market can actually be very productive. And there's nothing controversial or weird about doing that, right? This is why market makers exist. And it can help to create sort of a more it can help to address sort of volatility of a token, let's say. And so I think getting that kind of trading volume up, even off of in off-chain sources, is going to be a very decent step in the right direction. I also think that we need to start focusing on more of these like more revenue centric components to the protocol. And so just a couple of days ago, when I had this other when I had another AMA about this exact thing that we said probably won't happen that ended up happening, I mentioned that one of I've got my mind on a couple of problems that I think are still sort of systemic to DeFi and things I would like to do about it. One is, for example, this liquidation issue. I don't think that the borrowing and lending markets are it's not that the protocols that do the borrowing and lending are doing a bad job of it, but I think that the liquidator bots, which is effectively a type of MEV, I think that these markets are entrusted to them might be problematic, and I see that as a problem worth addressing. And I think that with the BN tokens that Bancor has produced. And also with some of the like the fact that it has an internal exchange means that the Bancor protocol might actually be extremely well situated to liquidating its own pool tokens if they're used as collateral somewhere else. And so we are still in the process of creating a security module with Aave, and I think that creating these lending markets is going to be, something very, very interesting. It also helps stave off some of the problems that we saw today, because if you've got something else to do with your pool tokens, it will just through Brownian motion mean that these very large, threatening, queues of withdrawals that are getting set up will will be much more difficult to set up. And with those lending markets set up in the way that I would like to set them up, because the Bancor protocol is effectively the only entity capable of skipping the withdrawal period if it does need to liquidate something, that it gives it sort of this advantage over the liquidator bots that it would be competing against. And this means a couple of different things. One is that we can make sure that these liquidations are handled in a much more responsible way, so that we don't have these huge undulations in the markets that don't really help anybody. And two, it means that the protocol will have access to sort of an exclusive form of revenue, and it doesn't necessarily even need to be that much to be extremely profitable. And also, caring for the user that is being liquidated, right? So that we don't massively underbid, for example, for the collateral or something like that. And also manage, basically help manage these lending markets, because I do think that they're dysfunctional. So it's kind of the next thing for me. I think that the people that came before me at Bancor, because I didn't design version 2.1 or version 1, and I obviously had a huge amount of help designing version 3. But it's still it's still just an exchange. I would like to see version 3 really start to get built out with more of these features that turn it into more of sort of a generic financial resource, right? A part of the infrastructure. And lending markets is something I'm going after, but not in the sense that we just create sort of these siloed these siloed lending markets to manage the risk or something, but something where even the liquidation itself can be handled at the protocol level. And I think that that's super interesting. The other thing that I think is problematic is the appearance and distribution of new tokens. And I've seen a lot of really good projects fail when they didn't have to, because they tried an airdrop, to get their token out in the wild, and they probably had every intention of setting up a fairly decently sized Uniswap liquidity pool for it, and users might have provided liquidity and received liquidity mining rewards, and so on and so forth. People would have traded it. But they for whatever reason, some part of that process didn't go according to plan, and people either pre-farmed or spammed actions in order to get most of the airdrop. Some smartass creates a honeypot scam or something on Uniswap with the same token pairs, or with a horrifically imbalanced pool that, after someone adds liquidity to it, opens up a catastrophic arbitrage opportunity. All of these things. It's just it's chaotic, right? It's disorganized, and I think that it can be done better. And I think that Bancor can help people do it better. I like the idea of having something like a flexible bonding curve, something that is can be transformed between constant sum and constant product. Not quite like the curve stable swap invariant, but sort of similar in idea, I guess. Where early investors, for example, if they acquired their tokens through a Dutch auction and were paying with something like USDC, and that is part of a fund that goes back to the developers, that if they are upset with how that Dutch auction went, right, if the outcome and the people with whom they now share this token, if they want to get out of that, I feel like they should be able to, without impacting the actual at this point virtual price of the token, and without without hurting any of the other investors in the process. And this is something that I think is kind of missing, right? This ability to slowly realize the launch valuation of a token, and then be able to slowly dial in price discovery for it. So the people that are the early adopters, maybe they're your Discord users, or maybe they're seed capital or angels, it doesn't really matter, but you just want to treat them well so that they don't feel like they're taking on a huge risk by participating in your funding round. but also that that there is a price discovery mechanism built into the process, such that when they do decide that they want more of that token, or if they want to get rid of that token, or something, that it does have an impact on the way that the token performs. So yeah, these are the kind of the two big things that I've kind of got my mind on for the next phase of Bancor version 3. And some of this stuff is already at least partially specced out, some of it not. But yeah, it's there's still so much work to do. I see nothing but opportunity, and I think that if you give me some time, if you see the kinds of stuff that I've been working on, and how it's good for people, right? How it's not just a rent extraction scheme, but also something that's intrinsically, positive and supportive. I think I will be able to regain your confidence, or at least I really hope that I will. And
I'm sorry. I think what would help though, is that, because I understand what you're saying, but a lot of that sounds like that's going to take some time. And so when people hear, "Hey, now the 100% and permanent loss protection is now gone," for some period of time, I mean, is that a week? Is that 2 weeks? Is that a month? Is that a year? And I understand there's some conditions around, well, what would it take to get it back? Because I mean, I've been with Bancor for I don't know, well over a year and a half, whatever it's been, and this is really just. I mean, I understand what's going on, but this is really not good, and I understand that, but that confidence, I think, is just going to be so hard to get back. And I understand what you're saying and all the mechanisms you're looking to do, but without some sort of like timetable or roadmap on when can I get that impermanent loss? Because right now my choice is to trust the protocol, or hey, have 50 or 60% impermanent loss. That's not what I signed up for, but I get it. I understand the market's crazy, the things like you said, the shorting BNT. Understand all that, but I mean, I'm not gonna lie. I'm kind of looking for some sort of additional roadmap of what it's going to take to get Bancor back to where it, the impermanent loss protection, etc. If that makes sense.
No, I totally get it. And so I think the first thing that we need to do is address the IL. And there's one major way that we have to do that. And for reasons that are for reasons that I'm sure you appreciate, I can't comment on things like token price on a public call or even in private, because we are very close with the regulator. But IL is a function of of the price of two different assets, and we know that the price of BNT is deviated in one direction, and so in order to correct it, we're going to have to push it back in the other direction. And there are a handful of things that I am investigating to do that. But obviously, you need the right resources. So we have work to do, and I have some good ideas, and I'm looking forward to presenting them to you. It's just too early right now to it's going to take time to fully assess.
Sure. Thanks for taking the question. Appreciate it.
Yeah, my pleasure. I'm sorry. I don't mean to be evasive with this shit. It's just it's an uncomfortable, it's an uncomfortable question to answer, and I apologize.
Sure. Thank you.
Okay. Thanks so much, SharpTX. So Isaiah.
Yeah. So I had a question in regards to what were some of the strategies or ideas you guys had around increasing adoption rate, as far as just I guess growing the visibility and awareness of Bancor as an option for people who are looking for decentralized exchanges. I know there's been a lot of questions around what it would take for new tokens or DAOs that have different tokens, I guess them looking at Bancor as an option over say Uniswap or some of the other dexes. But are there any, I guess, plans or strategies to really, I guess, start to, I guess, pursue, I guess, marketing strategies or campaigns to not only grow the adoption rate, but also just increase, I guess, general education around IL and also some of the benefits that Bancor provides over other dexes? Because I think that's one of the things that, I feel like a lot of people don't know about whenever I talk to them about Bancor. They're not aware of the strategic advantages that Bancor has over other decentralized exchanges.
We actually spoke about this, Mark, having almost like a DeFi 101 sort of thing where it explains all of these different aspects. I think the space has grown so much that to assume everybody knows these different things,
They don't, yeah.
they don't, you know? So the best thing that we can do is educate them and have them really understand it. And we were working on like another AMA series in order to really do that and make this sort of information digestible for everybody that's new to the space, you know?
Yeah. Yeah, absolutely. And it's interesting sometimes because, I'll talk to people about, some of the design, how the design of Bancor version 3 was, like what it does and how it does it. And you kind of discover things that like maybe people have just taken for granted and they never really understood. So things like, what is a pool token and how does it have value or how does it know its value? Because it's not, they're generally illiquid, right? You can't just kind of look on a bonding curve for a trustworthy price of a pool token because it's generally denominating, some other type of value. And if you push people for it, they might say, look, you've got me. I've got no idea how a pool token actually works and what its value is. And, I've been kind of, exploring this idea, as Jen said, of kind of creating like a DeFi 101. Like, what are the fundamental components of DeFi? And, what is a bonding curve? And what does constant product mean? And this kind of stuff. And yeah, I agree with you 100%. And I think that that's kind of the prerequisite, right? We've got to introduce all of this, low level, fundamentals first. And then I think on top is where you start building the narrative about, why, like, what's the difference between, Bancor version 3 and Uniswap v3 or, SushiSwap's Trident when they released that and Trader Joe. And, there are all of these different options and we can just explore, what they all do differently and, why some people like some protocols and not other protocols. And I think that it would be a very, very good, very positive way to go about addressing the DeFi users' lack of education or apparent lack of education. And yeah, it's something that I'm spending more and more time thinking about and getting more excited about.
Isaiah, thank you so much. If you want to, I don't know if you already follow Bancor or if you follow me, but it's definitely something that we're looking to introduce and have been speaking about introducing. So it sounds like you might be able to help spread the word and we might together, like all as a community, be able to really educate each other more so on like what DeFi is and what the different aspects of it are. So thanks so much for coming up.
Yeah, absolutely. No problem.
Rhett, if you want to unmute yourself.
Hello, thanks for taking my question and appreciate you hosting this. So I've spoken with a few of your people before and have taken some interest. I work for a fund, we manage a stablecoin yield fund, and we're kind of considering deploying some assets to Bancor. But the thing that I couldn't really get comfortable with is it feels like the mechanism for mitigating IL is subject to essentially something similar to a death spiral risk, right? So if there's a lot of IL and you mint the Bancor token, and then that can cause it to melt down further. So I'm just curious if you guys have explored any other, and maybe you got to this earlier, but I'm curious if you have explored any other methods for mitigating IL, such as like using options.
Squeeze. Yeah. No, I think one of the most interesting ones, and I think probably, like one of the most significant like innovations in in like options in DeFi is Squeeze. And it is possible to create because it is a nonlinear instrument, and it is kind of built around bonding curves. If you've got if you want to provide liquidity with something like USDC ETH or something, then you can sort of hedge that position very easily with Squeeze. When Squeeze appeared, I remember thinking that I wanted to incorporate something like that into the design, right? Or if we can have some sort of options market. And it actually comes back to a much earlier design principle, like some of the earliest suggestions for getting around IL is with options markets. And Andre Cronje has, I think, previously espoused that he wanted to create like these really deep options markets for making IL a thing of the past. And it would work, by the way, if someone was to achieve it. But unfortunately, it's kind of weird. Options in traditional markets, I think, are traded at orders of magnitude higher volume than the things that they are an option on. Whereas in DeFi, it's the exact opposite, right? The options market is extremely thin, very, very small volume compared to the assets themselves. And the problem, I think, is liquidity. And I've met a bunch of option protocol designers over the past year, I think, since ETH Denver. And, I think there's a lot of attention paid to sort of how the options contract will work, but not necessarily how to make the option liquid at the end. But it could be that, someone is going to figure this out. And, I'm not suggesting, I'm not going to figure it out. It's really, really hard. But someone probably will. And I think that when we figure out how to make the options markets in DeFi deep enough and that people are confident using them enough, that, we will have, a fairly good answer to something like, impermanent loss on an AMM, where you can literally just buy the insurance contract. And it's such a lovely ambition to be able to do that. It would certainly make everything that Bancor does a lot easier, right? We could very easily pivot to such an options based system if funding for it was good enough and it was sufficiently liquid. But that's probably the best example I can come up with of one way to do it, and we know that it would work, right? It's clear as day. But the problem is you've got to find trading liquidity for it, and you've got to find people to write the puts, and it's just not as simple to throw together in the DeFi world as it is in the TradFi world, unfortunately. But if you really wanted to get into it, and it's something that you're looking into because of I think you said your fund, or your colleagues are asking about it. I would say that this is probably the best place to start looking. And let me know if you find an options market for the assets that you're wanting to contribute to an AMM. Because I'd be really interested in studying it. I haven't really found one that I would consider to be reliable.
Yeah, we've seen the same issue of thin options markets, where we do some things with options, but all of the stuff we do is on OTC with OTC desks, because DeFi options markets are too small. So I get the problem. It's not an easy one for sure.
But a great one if we got it working.
Yeah, I'm hopeful. Appreciate you taking my question.
Thank you so much, Rhett. Appreciate you coming up. Percy, I see you're unmuted. If you want to go ahead and ask your question. Percy.
I think I was talking for too long, and you might have abandoned it.
No, he was new up here. Okay, well, I'm going to remove him. Okay. It doesn't look like we have any other questions, Mark. I think really at this point, it's just kind of a matter of keeping the community updated. Their assets are safe.
Yeah, I think I'm going to be making a lot more appearances than I otherwise would until everything's back to normal. And if people want to, as always, right? If people want to reach out and ask for anything from me, I'm more than available. But and I just wanted to say, thank you to everyone that showed up. I know that we had a couple of antagonists on the call, and I've seen a couple of people sort of coming to my defense for that, and I just wanted to say that they have good reason to be upset with us. Like if I put myself in their shoes, I would be pissed off. And I don't think I just wanted everyone to sort of acknowledge that. And that there is going to be some Bancor bashing, and people are going to come after me and some of my colleagues, and and everything else, and maybe just let them do it for a little bit. It's I think that we're in a catastrophic bear market. Emotions were already running high. Things were already like looking as bad as they could possibly get, and then Bancor switches off the IL protection. It's just I imagine for a lot of people we added huge insult to injury. And I don't want to say that we like deserve some of the abuse that we're surely to get, but I think that the people that do want to abuse us deserve some understanding as well. And yeah, so just if you see any of that, don't take it personally, and don't feel like you have to take it personally on my behalf or something like that. I think that we did upset a lot of people, and they have very good reason to be upset. And I can take it, and it's not going to distract me from making sure that the protocol gets back up and running really soon. So thank you everyone for coming and for listening, and I hope that I've put your minds at ease at least a little bit.
I wanted to say one more thing, Mark. I saw a tweet earlier, and I'm not going to say, but it said risk management in DeFi is hard, and I don't think any protocol has perfected it at this stage. But dApps need to start to think more deeply about worst case scenarios and how they plan to handle them. And if your dApp allows for something to happen, you have to assume it will. And with that, I want to, yes, like I think that people are disappointed, and I understand that, but either we took action and we did something like this, like temporarily disabling the impermanent loss protection, or we just allowed that to happen, like the actual protocol to die. And maybe I just want to defend you a little bit, because the market has been such shit lately, and with people acting with malintent like we're not, and I just wanted to add my own 2 cents to that. After listening to you and everybody else for 2.5 hours, I felt like I wanted to say that on my own.
Thank you, Jen. It's very kind.
Yeah. With that, thank you everybody for joining the call and for asking your questions. And just as much as Mark put himself out there with his DMs, mine are open as well. So please reach out if you have any questions. And Mark, I'm sure we'll be getting up here again soon and doing another community update as often as we possibly can.
Yeah, I'll see you all real soon. I'm sure of it.
Awesome. Thanks so much.
Ciao.
Bye.